Hi, my name is Kevin Retcher. I'm the owner of First Meridian Mortgage. Hey, what I wanted to talk about here is the 0% down program through United Wholesale Mortgage. It's an interesting program, in my opinion, that could help out a number of homeowners, okay? CNN is taking a little bit different spin, saying buyer beware, and I'll get into some of the pros and cons of their opinion and also my professional opinion, okay? So the way the program essentially works is it is a 3% down payment assistance program up to $500,000. There's two programs, one's Home Possible and one's HomeOne Ready, okay? So let's go through a little bit of numbers on the program as I kind of see it, okay? All right, let's go through some of these numbers on a $500,000 purchase, okay? On a $500,000 purchase, the 97% portion is $485. You see that here? The second trust that would be provided by United Wholesale Mortgage for the 3% is 15 grand. So let's look at what that represents from a payment standpoint. If we're looking at UWM's pricing today, the mortgage insurance is at 0.3%. This is with someone with a 780 credit score. If you have a less credit score, the mortgage insurance will increase, okay? So just keep that in mind. If we're looking at those numbers, on 6.875, principal and interest would be $31.86 and 10 cents. MI 121, mortgage insurance for 121, the taxes for 425, insurance at 200, HOA at 125. Payment would be $4,057. That is a zero down deal at $500,000. Now, what's the income needed for that? Depending on calculations of your, if you have any other debts, I'm going to use a 41%. They will go up to 50. So I'm giving a 9% margin there. You would need roughly about 98, 95. Per month, which would be about $118,000. If you had no debt and went to 49% ratio, then you would need about $99,000. So here is a little bit different twist. I did the $500,000 prior and the 485 with a $15,000 second. But in theory, in the DMV, I think this is going to be more applicable, okay? If you were to do 97%, and assuming that you qualified, right, on a $750,000 purchase, 97% would be $727,500. And if you took out the second trust for $15,000, right, that would be 2% on $750,000. So in this instance here, you would need to contribute $7,500 of your own money. So this is a twist on the program that a lot of people aren't talking about, to where you could put 1% down up to $750,000. So the way to look at the program essentially is anything above 500, you actually can do higher loan amounts with a contribution from you as an individual. Okay, so that makes the program even better, in my opinion, and also debunks some of the CNN information on, worried about 0% down, because in some instances the client may elect to actually put 1% down. The program does have a minimum cap. 95.01% is as low as you can go. So you can't put 20% down and take out the $15,000 second. This is for higher loan to values. Now, keep in mind, it's also income based. One of the criteria for the Home Possible is a minimum of 620 credit score, and the HomeOne has a 700 credit score. So the HomeOne is a little bit more restrictive on the credit score based upon the ability to not have an income limit also. Okay, so looking at the program as a whole, some are saying out there, oh, there's grant programs out there that don't require you to pay back money. In some instances, that's true. And if you can find those in your local area, then in fact, totally advise going ahead with those. Same lender, UWM, has a special purpose grant program that if you're eligible, you can get up to $5,000 toward your closing cost or down payment for free that doesn't need to be paid back. So there are variations of different programs out there. I'm not saying that the UWM program as a whole beats some, a similar grant program if you don't have to pay that back. But it is a 0% interest loan for as long as you have it, which makes it pretty strong and has its purpose for a situation where someone has great income, for one reason or another hasn't saved money, or in fact, if they just want to keep a little extra in the bank so that they're prepared for their home purchase. So that's my spin on it. Let's go into a little bit of CNN's spin, okay, and listen to what a professor has to say, and I'll stop at a couple points and go into some of my opinion of his commentary.
Explain how this program works, and does it make you nervous?
I'll answer the second question first. Yes, it does make me nervous. The way that it works is it's geared toward first-time home buyers, and the Fannie Mae has a program where it will purchase loans that have a 97% loan-to-value ratio, meaning that the loan is equal to 97% of the home value of the home.
So let's talk about the 97% that he's talking about. Fannie and Freddie both have the product. He's incorrect on his research. This is a Freddie product, has nothing to do with Fannie. They both have a 97% program, Home Possible and Home Ready, but he's talking about a program right now that is through the wrong entity or GSE. So he hasn't done his homework, so that already puts me on edge that he doesn't know what he's talking about. Okay, and then a side note is there's mortgage insurance on these. So if the loan goes into default, the lender is going to get the payment from the mortgage insurer for a loan in default.
Purchase price, and what United Wholesale Mortgage has done is it's kicked in the final 3%, which means that the purchaser of the home and the borrower of the debt doesn't have to pay any down payment. So they have no equity in the home from the get-go.
So again, just to reiterate, VA loan has done that way for years, no problems. USDA the same. There's plenty of FHA loans that allow second trust also. And I don't hear him talking about those right now at all.
And the way the program works is UWM, or United Wholesale, will have a second loan.
A second loan at 0% interest. Again, let's go back to the equation. If someone's going to give me 0% for 30 years, I'm going to take it. People will do that for 12 months on a credit card.
That they make to the buyer, and that second loan will then be repaid when the home is sold or refinanced. And the first loan, which is up to a 97% loan to value, that mortgage is sold to Fannie Mae and goes through the traditional channels of typically being sold into the secondary mortgage market.
Okay, so I mean, what's dangerous about this setup, or what worries you about it? And is this like what was happening in 2008?
So it's not.
In 2008, people were doing no income, no asset type of loans, 80/20s with 1 year ARMs or 1 month ARMs that had deferred interest. At one point in time, Bear Stearns and the government, a pet peeve of mine is the government knew what was going on with Bear Stearns, and they told Bear Stearns that they were worried about payment shock, and they essentially made them allow a 5-year payment on the NEGAM loans that stayed steady. So the government actually knew what was going on even back then, and they gave Bear Stearns the opportunity to change their program slightly, but they changed it in a way that basically had a ticking time bomb for a little bit later because of the deferred interest. And they essentially, when they had to make their full payments, they were 2 or 3 times the amount. So in general, the government knew what was going on even back then, okay? These loans are fully underwritten with standard ratios of which the people qualify. So it is not the same thing.
Like what was happening in the sense that there were many other actors involved in the problems of 2008, but this is one component, a very important component, where it does begin to look like the erosion of underwriting standards.
How can there be erosion of underwriting standards when, one, you don't even know what entity's doing the underwriting, and two, it's being done on a full income, full documentation basis. This 97% program that's being used has been used since 2014, okay? It's 3% down. UWM is taking the risk of this second trust. They get paid last, okay? Yes, they're getting their money back. It would be great if it was something that expired after a great number of years of payments. But in the sense that they're not charging any interest, why would they do that?
Now, United Wholesale has said that underwriting standards are much better than back in that period. They are correct. But one of the primary underwriting standards is how much of the home value is being purchased with debt. And typically you keep that at 80%, not.
So I did a 12-month history, the last 12 months of my loans, and my average loan to value was about 78%. That was to take into consideration even my VA loans. My VA loans were around 88%. So in general, his statement of the 20% is slightly valid, but I have a whole slew of people that put 10% down, 5% down, 3% down, and I have a lot of people that put 40% down. So my clients that put 40% down skew the numbers dramatically in that regard. But in the instance of the amount of money that people put down, 3, 5, 10% down programs have been around for an extremely long period of time. They just carry mortgage insurance or FHA backed or VA backed. Anything less than 20% down is going to have some type of protection from the lender. And that's just the way it is. It doesn't make it a bad loan. And typically with the amount of equity that's being gained, most people, when they do their first refinance, are going to get out of the mortgage insurance and they're going to have the equity position anyway. And if the standard equity are 5% year over year, the person's going to have equity in a period of like 4 months. So I just don't see where this correlation is going to come into play. And if you're worried about 2007 happening versus now, if you actually do the research, home builders were building more homes than the amount of household formation back in 2007. So there was a lot of people speculating, buying investment properties at that time and flipping them and making money. If you look at the Gen Z and also the millennials household formation this year and last year, they are the biggest group that has household formation, and it's greater than what home builders are building. So there's a scarcity in the amount of homes. So home prices are not likely to decrease. And then second of all, if interest rates actually come down, then there's going to be more buyers in the market, causing more scarcity. So in theory, getting someone into the home now is actually helping them build equity faster because they won't be in that pool when interest rates go down of not being able to buy. So helping them now is going to help them faster, quicker, and they're going to build more equity sooner.
Not 100%. And the lower, the better in terms of safety. So in this case, going to 100% is unusual and it's relatively high. Secondly, these loans are geared toward individuals that make 80% of the median income in a particular area. So they're being targeted toward those individuals that cannot accumulate a down payment, which seems appropriate, but those individuals also can't withstand things such as a temporary loss of job or other disruption.
Again, just to reiterate, he's making the assumption that they don't have the money. The program is designed for people that don't, but it doesn't mean that they actually don't have the funds. Maybe they just need that little extra to get them over the hump. Let's talk negatives about the 0% down program. There's one negative that I can find that no one has brought up, and there is a fee, not unlike any other fee. Most loans have an underwriting fee or an admin fee with most companies. UWM is charging $1,070 for the recordation of the DPA fee, and also $186 transfer tax. I am trying to get that clarified, but it does look like that's the number. And I'll let you know, and I'll do an update if that's different. Okay, so that's probably one of the major drawbacks. If you were getting a $15,000 second, that would be about a 7% upfront charge, even though it's a 0% interest loan. So it would take you a little bit of time to recoup that money in conjunction, like if you were to invest the $15,000 and in lieu of doing the second trust. Like if you had $15,000 and you're deciding, do I do it or don't I? I might decide not to do it. It just depends whether or not I really wanted that security or not. The other thing would be is if you could get the sellers, if you have any type of seller credit that would actually pay that fee for you, then I'd probably do the second. So I'd have to weigh that in conjunction with the program itself. But for the individual that has no cash for the down payment, the program does have its pluses in that regard. And then if you have a good agent negotiating potentially seller concession or something of that nature toward the closing cost, then the program is definitely a solid program. Again, my name's Kevin Retcher. If you'd like, share, and subscribe, I appreciate it. And if you have any questions on the program, give me a call. My phone number is 703-799-5626. I am licensed in Virginia, Maryland, and D.C. And if you need a real estate agent, I have over 500 in my database. I'd be happy to refer someone to you. And we go from there.